Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. Let's talk about home buying, one of the biggest milestones in pretty much anyone's life. It's very important. Let's get into all the nitty-gritty and make it feel a little more approachable. With buying a home, how do you know what you can afford?
So when you look to buy a home, the number one thing that's going to get involved there is what is your income versus what would the payments be to buy the house. A second aspect of it is whether or not you have enough money for a down payment on the house. And so those are the two critical things that are going to be looked at if you're trying to get a house by buying a mortgage. That assumes you're not buying the house for cash. Most people cannot buy a house.
Have to take out a loan.
They have to borrow the money. And a loan against the house is called a mortgage.
A mortgage.
That's how, because the house secures the loan. If you don't pay back the loan, the bank takes the house. Not a pleasant experience.
Yes.
So the mortgage is the payment, is the debt against the house.
Okay. And now, is there typically a percentage of income or savings that the house or the down payment, the monthly payments need to be less than?
Yes, there's a typical kind of formula. It doesn't have to be done this way, but it usually is. Usually when you're buying a house, your goal is to put down 20% of the house as a down payment.
Okay.
And 80% of the cost of the house will be the mortgage amount. So when you're doing that, they're going to say, okay, do you have that 20%? Right?
Yes.
That's question one. Question two, that 80%, do you have enough income to make that work, number one? And do you have enough income considering also all the other debts that you already have to make that work? When you get into the whole income side of it, there are certain percentages of your income that matter for this. If you have a mortgage amount under about $700,000, it's what's called a conventional mortgage.
Okay.
And so if you're doing a conventional mortgage, typically speaking, they're going to look at something like 28% of your gross income. So that could include bonuses and some other things usually. 28% of that number should not be exceeded by what the mortgage payments are for that 80% chunk that you're going to use to buy the house. Okay. So they're going to calculate what that 80% is in a monthly payment. And by the way, they're going to include your property taxes and any homeowner's insurance in that number. So it's the mortgage payment
it's the
plus
monthly payment against your income?
Correct.
28% of your income?
Correct.
Okay, I understand.
Yep. Now, they're also going to look at everything else where you owe money already. So your student loans,
credit cards.
your credit cards to a certain degree, only if you keep balances outstanding, really. A car loan, for example, if you have a car loan already, that's a part of it. All of that typically cannot exceed another 5% of your income.
Okay.
So if you have very heavy student loans, you may be making it difficult to get to get the maximum kind of house that you would like to get, because that other aspect of it will be looked at.
Yeah, so keeping your debt down will be a helpful way to be able to afford a mortgage or be approved for
a mortgage. That's exactly correct.
Okay.
Exactly correct.
Where do you go to apply for a mortgage? Do you go to a bank? Do you go to a company? How does that work?
Okay. Today it's become more common for people to go to what's called a mortgage broker company. It could be a mortgage broker is somebody who finds money from other mortgage companies. A mortgage banker is somebody who actually has their own money that they lend out.
Okay.
So a mortgage broker now is very common. It's a lot less common today that people just go to their own bank and say, I'd like to get a mortgage on a house. What is your rate? And today there are websites that make this amazingly quick and easy to see what might be the best funder for your mortgage. There are also websites, by the way, to figure out what might it cost? What would be the amount of the mortgage if you had that funder for this dollar amount, and that funder is going to be at this percentage. The most common mortgage is 360 months.
By percentage, you mean interest?
Interest rate percentage, right? At this percentage interest rate. Most mortgages on houses are 30 years or 360 monthly payments.
Okay.
So you're going to figure out that monthly payment by putting that information into a calculator, an online program, for example, and it will tell you what the payment would be for a certain amount of debt. It will also tell you if you make a certain amount of money, how much mortgage you can afford to fit within that 28% boundary.
Well, I'm sure it's also going to depend on how long you expect to be at that job in the workforce making that amount of income, because if you're having to pay the same amount on a mortgage payment each month, you need to make sure that you still have that amount of income.
You do,
by
but
the end of the mortgage.
That's not a qualification question.
Okay.
In other words,
that's on you.
Yeah, I mean, you know, they're expecting that you're planning to stay where you are. If you were to tell them, yes, I'm making this much now, but I'm planning to leave in 6 months and I'm going to be earning 30% less. If you were to tell that in an application process, if that were the case, which you should, because it would be fraudulent probably not to tell that if it's true.
If you already know.
If you already know, then they're gonna try to underwrite the mortgage based upon 30% less income, not based upon what you're earning today.
Yeah.
This all gets even more difficult if you are self-employed. For self-employeds, where there's not a salary, proving your income, because they want to see, your what's called Schedule C. They want to see that income for typically 2 years, maybe 3 years. They may want to take some sort of an average of that time period, not just look at today, where you're at today. So it gets very complicated if you're self-employed trying to get a mortgage. Much, much harder to get a mortgage for a self-employed person.
Well, that's good to know, because I know there are a lot of, that's with the gig economy, like it's very popular.
Yeah, a lot of people are just becoming independent contractors, working on their own, having their own businesses. And if you're doing that, it does make it more difficult to obtain a mortgage on a house.
Just means that you need to be more organized in keeping track of everything, I'm sure.
Well, you might also face slightly higher numbers, slightly higher. There may be things that they don't allow. They may want to delve more deeply into your spending and everything. Not your monthly spending, but what you're spending in your business. Are those all real things like that? So it's harder to. The bar is higher. The numbers and the expectations are not quite the same. They're higher.
Okay.
Because the income is considered riskier.
I see.
Whether or not that income will continue to be at those levels is considered to be riskier if you are self-employed than if you're a salaried employee someplace.
So let's say that whether you are self-employed or employed by a larger company, you've figured out what you can afford in a home. Where does the buying process start?
Well, from my standpoint, the next best thing to do is to go back online and look at one of the there are many websites out there of houses that are for sale in a given area. You just put in a zip code or something like that and you'll get lots of houses. You can search by typically metrics like how many bedrooms you want, what price range you're looking for, how many bathrooms you want, do you want a pool, do you want some sort of a view, so all of these things can be searched. And what you need to do is get an idea whether or not what you're trying to do is reasonable. Okay, so before you go and try to get the 5-bedroom house with the pool overlooking the ocean for $230,000, find out whether or not that. Make sure that you can afford that if you're not on a show in the Caribbean or something, about buying homes. So just get an idea that you're in the right ballpark with it all. Yeah. And for the area you're looking for, all of that. Then, from my perspective, the best thing to do is to find a very good realtor, a person who can lead you through this process. Because a realtor's job isn't just to help you find a house. A realtor's job is to help make the deal happen, to help you with all of the details that are going to occur over the course of a process that probably is going to be about 2 or 3 months long and that you've never been through before. It's very, very helpful to have a really good realtor, someone with very good communication skills who really is trying to work with you to get you what you need.
So they're kind of your cheerleader,
the cheerleader, guide, there are a lot of different things all wrapped up into one person. And when that person is really good, it's really good. When that person isn't as professional or just isn't as good, it's a more difficult process. More's on your, more's on your back of the whole thing. Yep.
So during the offer acceptance period, when you're, putting in an offer, what does that look like? Are you telling it to the realtor? They're telling it to the homeowner? What does that actually
No, it's
entail?
actually typically more formal than that.
Okay.
Usually you're actually creating a contract, a proposed contract.
Ooh.
And because you're also putting in it any sort of stipulations that you have, any conditions that you have to it. If there's something in the house that you want that they might otherwise take with them, things like that you might put into the contract. If you're going to have a mortgage contingency, meaning if you don't get a mortgage, you're not still obligated to purchase the house.
Because you can't pay for it.
Because you can't pay
Got
for
it.
it. And so you might be damaging the seller if you can't pay for the house, and they would have a legal case against you. So you're going to have a mortgage contingency clause if you want to have a mortgage, if you're planning to have a mortgage. All of these things are what a good realtor will work with the person on and help guide them through this process. So that offer is going to be a written offer with a contract, in a contract, that's going to be specific now on what you're looking for. It may not be your final offer. You may be willing to pay more money. You may be willing to change some of the stipulations, but it's going to be what you're asking for at this point in the process. You'll then get a response back from the other side, typically, that says, well, we'd like to make the following changes to your offer. We want more money. We don't want to leave behind, Grandma Smith's bureau or whatever it is that you said you wanted. All of whatever those conditional things might be, they might want to change it, or they might want something different. So then you're going to respond again. Do you agree to those terms? Do you want a price in the middle of those two terms, et cetera? And again, this negotiating strategy, because that's what a lot of this is about. You're strategizing about how to negotiate with these folks that own the property. And you're at a disadvantage, by the way, because you're already emotionally caught up in buying this house. If you're buying a house, you are quickly emotionally attached to that house.
Because you're imagining your life there.
Yes, and if you don't imagine your life there, you probably shouldn't be buying the house. If you don't feel it,
Yeah.
So you're going to go back with another counter offer, basically. All of that part of it, that strategy in that part of it, the realtor is critical to that aspect of it.
When does a lawyer need to get involved? Because I know we're drafting deals, we're sending those. Does a lawyer get involved with any of that, or is that once you've had the offer accepted?
Once you have an offer accepted, once you've come to a deal, quote unquote, and it's been drafted and both sides have signed a contract for that, then it goes to lawyers. And lawyers are typically going to take a period of time, at minimum 3 days, but what happens is that gets thrown out the window immediately. Just prepare yourself. Never 3 days. It's like the first thing they say is, we object to the 3 days, and that's it. It's out the window. And then the lawyers are going to look at the contract and say, for this deal, I don't want my client to have the following parts of this deal. Now, if it's part of what you already agreed to, that can be a problem.
Yeah. It's like going back on your word.
It's going back on your word. So it's typically not done unless there's something about the offer you made that you just didn't realize was a big liability for you or a big problem for you. And people understand sometimes deals don't work out.
Yeah.
So if there's something that you want to do differently, well, you have to do what you got to do. You can't, going into a bad deal is worse than going into a good deal and having it not work out.
Yeah.
Okay. So the lawyer's going to be involved at that point, and that could go on for a couple weeks, typically, where there's some back and forth, some problems, some issue. But eventually you're going to agree on terms if the deal's going to continue. You finally agree on terms. It's redrafted. Everybody re-signs it. And then you really start the process of trying to get the house.
Yeah.
So now you make a mortgage application. And now
so you haven't applied for a mortgage before this?
You may have gotten what's called pre-approved, which means in general they've looked at it and they've said they said this looks good, but it's subject to a final review.
And then you finally apply once you know that the house is yours.
Yes. Well, no. Once you know you have a contract.
Okay.
Because they're going to want to see the contract. That's going to be part of the submission made to the.
Because the price that you decide on is going to affect the cost.
Correct.
Of
They
your
want to see that. They want to see that this is actually happening and that you're not just borrowing money and going to run away with it. That you're actually purchasing this house. Well, there's all kinds of fraud in the.
I believe it.
So then you're going to get an inspection. Right. Somebody's going to take a look at the house and make sure that various parts of the house are functioning as they're supposed to be. There may be testing for something like radon. Some states make you test for chemicals and stuff in the ground, and oil tanks, and so there's a whole bunch of risk kind of testing that happens.
Who has to schedule those inspections and who has to pay for those?
That's negotiated,
Okay.
but typically it's going to be the buyer paying for these things
Okay.
and managing that process.
Okay. So once you've gotten, your inspections done, well, I guess, is there a time period that those inspections need to be finished in? How do you decide when closing is?
Yep.
What is closing?
Yep. So as to the inspections and timelines, that's always in the agreement.
Okay.
By when the
It's already
inspections
been
have to be done.
decided.
And part of that is because the inspections give you the right to back out of the deal. If you find something in the inspection that you can't live with, you can tell the other side that you want to terminate the deal.
Yeah.
And as long as you do it within the timeline that's written into the agreement, there's no problem with that. As to the closing, well, you don't really get to the closing. At the next step is to qualify for the mortgage.
Oh.
Okay, so you've applied for the
Skipping
mortgage,
ahead.
and while all this other stuff is going on, you're also trying to get that mortgage and getting all the information to the mortgage company, and eventually you're looking for a mortgage approval for that mortgage contingency to go away. The money is there. They've told you they got it.
You're going to be able to afford the house.
And so what you're going to do is, generally speaking, you're going to set a closing date for a date in the future, past the point where you're pretty sure you're going to have your mortgage done.
Okay.
And so you're going to set a date to quote unquote close, to transfer the title of the house officially over and pass all the money back and forth.
Yeah.
Okay. Couple other things have to happen because every house has what's called a deed, and the
How is that different from a title?
it's conceptually it's the same as the title on a car. Very same concept. Okay. So the deed on the house says who owns the house, but those deeds have been filed with a county going back maybe hundreds of years. So all of this information has been kept in county records for a long time. And what's going to happen is somebody's going to go through that information and make sure that the person who says they own the house owns the house,
The person who owns
and make
the
sure that there are no loans against the house or liens against the house or problems where these people shouldn't be transferring that property over.
Okay.
And the bank is going to insist on that. The mortgage company is going to insist on that to protect their investment in your house, basically, and it protects you as well. So that's called a title search, and that has to be done. There would be no reason not to get a title search that I can think of. So, you get that title search done, and then the rest of it is really purely mechanical. What is the paperwork that's going to be needed? If you're doing something on a certain date, then you're paying property taxes if you own the house up to that date, and you're not paying after that date, but you may already have paid for 3 months in advance, so you're going to be due some money back. So at closing, there are often some
Things you got to figure out.
Yeah. And so all of that gets figured out into something called a HUD statement, Housing and Urban Development Statement. That's the department with the federal government. And you're going to receive, a couple days before the closing, you're going to receive a statement that says, here's where all the money is going to flow when we do this closing. And this money is owed for property taxes, and this money is owed for interest for the first 30 days or 10 days before you make your first payment. And all of these just little details of it have all been figured out. This is a lot of what paralegals do in law firms, is create these statements. And it will tell the seller how much money they're ultimately getting at the end of the deal, because their commission is paid, that comes out of it, and
Like the
legal fees
Realtor.
come out of it. The Realtor commission gets paid out of it. Any fees to lawyers get paid out of it, et cetera, et cetera, et cetera. So, and then what check amount you're supposed to show up and give on the date of the closing to make the whole thing happen, because it's going to be the down payment. Well, you may already, by the way, have put down a security deposit, It's often, at first it might just be a few $1,000s, but eventually you have to put down a significant amount of money. So it might be 10% of your 20% deposit is going to be put down. And then you're going to come with the balance plus fees plus various charges that you have to pay for. You're going to come with a certified check for that. Can't bring cash, can't bring just a check, because they don't want to take a chance that it bounces.
Yeah.
Because they've already transferred the deed.
It's a lot of money.
It's a lot of money, and they've transferred the deed. They're transferring the deed that day. So they're not going to transfer it and find out that they didn't get paid.
Yeah.
So you have to bring effectively good money, which is to say a cashier's check, something like that, a certified check. And that's kind of the process.
Question, if you say you've been living in a house for 12 years, you have a 25-year mortgage, and you haven't paid it all back yet, obviously, but you go to sell your house, what happens to the mortgage that you've been paying back?
One of the things that the paralegal and the lawyer will be calculating is, as of that particular date, what exactly will be the balance on that mortgage, including interest that you haven't paid yet. And that amount will get paid back to that bank that day by the lawyer that does the closing. And the seller of the house will get their payments from the house less that amount. That's one of the things that's deducted out. It's subtracted from the seller's
Which is why
proceeds.
If you don't wait out the full mortgage, you won't make back the full price of your house when you sell it.
You won't get the full cash amount of the house when you sell it. So if you have a $500,000 house and you owe $300,000 on it,
You only get.
you're at most going to get $200,000 back, less all the other fees and charges.
Okay.
Yep, that's it. That's correct.
Well, I hope that the process of home buying feels a little clearer. You know what a mortgage is now, how to pay it back, so that you can know what you can afford and what to expect when the time comes for you to get one. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website, and make sure to click on to the next.